All right, folks. Good afternoon now. If you can have a seat. We know this is one of the toughest segments since it's right after lunch. So thank you for coming back in and supporting us. You heard the song, so the countdown is on. Diamonds, or what we think is going to be like diamonds for us, is coming. We are going to award our prize to the person that really likes tweeting. We're going to reward tweeting again. So please continue, keep that up. Keep answering our questions, and hopefully we'll have a winner here in a few hours. Now, for our panel in Innovations on Lending, Peter Maynard is currently the Senior Vice President of Enterprise and Fraud Analytics at Equifax. Prior to Equifax, Peter had an impressive career at Capital One, where his roles and responsibilities were centered on the use of information-based analytics in numerous applications, including credit scoring, marketing analysis, and data modeling strategies. So, ladies and gentlemen, please welcome Peter Maynard.
All right, thank you all. When I heard the Rihanna song, Diamonds in the Sky, I was thinking about the diamonds in the rough that these guys are finding with alternative data and kind of the new technologies, which is really what this is about in terms of how can we step up our game, not only from a data perspective, but from a lending perspective, and leverage really the potential that the technology and the data gives us. So it's very exciting that we're here today. I'm really pleased with the panel that we got. Let me actually turn it over to them. Let's start with Michael. If you want to introduce yourself.
Sure. Hey, I'm Michael. I'm the CEO of a company called FinanceIt. FinanceIt is a point-of-sale lending platform that operates as a marketplace. So on one side, we have a set of merchants who offer point-of-sale financing to their customers, taking a big purchase and making it a monthly payment that's reasonable and fair and transparent. And on the other side, we have a set of financial institutions that want these good quality loans but don't have the ability to put these platforms together themselves. So they plug their balance sheets into our platform, and we do all the heavy lifting with the merchants ultimately. So we're really a service provider to both a merchant community wanting to sell more stuff and a set of financial institutions that want good quality loans in their portfolio as a new origination strategy. I'm based in Toronto, which is where our head office is, and I really appreciate you guys cooling it down here in Atlanta for me, for my arrival. I really appreciate that. And the Raptors, I know you're going to be cheering for the Raptors tomorrow night, who are in town, so yeah.
Good afternoon. My name is Crystal Black, and I'm representing Can Capital today. I'm not James Mendelson, the CMO. He was unfortunate, was not able to make it this afternoon, but I am the VP of Product. I am based here in Kennesaw. Can Capital has been around since 1998, providing working capital solutions for small businesses. So we have a lot of experience with that space and a lot of interesting developments that have happened over those 16 years.
Rob Frohine, co-founder and CEO of Kabbage. Kabbage started the company back in 2009 with a couple co-founders, really built a technology platform over the next couple of years, and since 2011, we put out about $650 million in capital to small businesses throughout the US and UK. We're targeting putting out $1 billion to small businesses this year. The way the platform works, it's fully automated, so 95% of our customers have a 100% fully automated experience, landing on our site, going through the process of applying, getting access and taking cash, and that typically takes about 7 minutes from start to finish.
Good afternoon. My name is Mickey Conson. I'm the co-founder and COO of StreetShares. StreetShares is also a marketplace, but what we do on our marketplace is that we connect small business lenders with retail and financial investors. We focus particularly on really small businesses. So our loans, the largest loan we'll make is $50,000. And we co-invest in every loan on the marketplace as well. So our incentives are fully aligned with our investors. Our particular focus or difference from some of the other marketplace lenders out there to small business owners is that we really focus on affinity lenders or affinity lending. And we're particularly focused on veteran-owned small businesses. One of my co-founders was a JAG lawyer for 10 years and then worked on Wall Street. And so we've signed multi-year deals with the largest veteran-owned organizations in the United States, and are particularly focused on lending to veteran-owned small businesses, and they represent about 70% of our customers.
Excellent. All right, so here's the poll question for you all. So we're going to hear a lot about how these folks are really pushing the boundaries on lending and how they're using analytics, data, and technology to do that. And so really the question is, how is this going to get adopted by what we traditionally call the banking community? And really, this is going to be what we want to get your take on, and if you could respond accordingly, that'd be great. All right, so let me speak to a couple of things. When thinking about this and what we're going to be talking about this afternoon, stepped back and thought, gosh, what's changed, and why is this the time for this type of confluence of technology and analytics around this lending business problem? And I look at three things. The first is the ecosystem, the regulation that's happened, and really the fear for banks to be in this space. Having been at a bank in 2008 through 2011-12, it was really difficult in terms of making sure that things were going to stay afloat, making sure we understood our customers, and really just being now that kind of conservatism in terms of thinking about lending, which creates an opportunity. It creates a space that others can go into, and that's one of the things that's driving this. The second is the technology. As you know, the big data technologies out there make data so much more easily accessible and manageable. And then you have things like R, which is an open source statistical software. You don't have to have a license with some of these big analytic companies to get going. And by the way, universities use things like R to train all the millennials in how to do big data analytics. So there's really a sea change that's happening in terms of the ability of companies just to get in the data very quickly and start building their own solutions. But the last piece is really, I think, just the structure of what it means to be data. I mean, Equifax, where I work, we say we've been doing big data for decades, right? Well, we're not the only ones doing big data these days. You have social data. You heard about the Internet of Things. And that data is giving you an additional assessment about customers and consumers. And are they trustworthy? And that's what really this is about, is are they trustworthy? And so it's really exciting. I think it's tremendous times to do what we do because we have the ability to change that story about what does it mean to be a customer and a profitable customer with these new data sources. So if I look at those three things, they're really driving kind of where this innovation is, and looking forward to get their takes on how this is impacting their business model and how it's impacting them as a company, and then how it begins to impact the United States. So let me open up with the first question. I want you all to get to know these folks a little bit more. So let me start with really, and Michael, I'm going to go down the line again, and it's not because you're a Raptor fan.
All right.
But really, what's your entrepreneurial story? So how did you all come about? What was the market need that you saw where you said, hey, we need to do this, and we can do this not in a small way, but we can do it in a big way?
I could start with me, like I was born a small child, and then go forward from there, but I don't think everybody wants to hear that. So I'll start with the origins of our company. I came out of an electronic bill payment and presentment company where I was one of the founders for a Canadian equivalent of CheckFree, which is essentially, again, a great company out of this area too, and saw a lot of the flow of the household, how much debt was being carried, what interest rates were being paid, connected into all the financial institutions to get a sense of who they were, because our service integrated into all of the Canadian FIs, and we started getting very interested, myself and a small group of people, around this notion of maybe there's a better way between consumers looking for lower interest rates, financial institutions and the relationship they have with depositors. So our platform was originally a peer-to-peer lending platform. We created a company called Community Lend that was meant to be Canada's first and only peer-to-peer lending exchange. We started in 2007, and then in June, the entire world collapsed for financial services. And so we were in the middle of talking to a securities regulator about offering a new platform for consumer debt in the middle of probably the worst time to possibly do that. So after a couple of years of arguing with securities regulators, which I don't encourage anybody to do, by the way, at great expense and me going a little grayer, they finally allowed us in late 2009 to launch the peer-to-peer lending platform. But by then, we realized that it wasn't really ultimately what we wanted to do. Instead, we got very interested in point of sale, because during the collapse, not just you had this disruption in the way that the financial services industry was working, but the major players in point-of-sale lending, Wells Fargo Financial, GE, all of these major players on both sides of the border, Canada and the United States, were essentially retreating out of the market and leaving businesses without a solution. So we created a solution called FinanceIt, got it launched, raised some capital, started to build momentum in the company. And then in late 2013, we took a large investment round that was led by a company called FIS Global out of Jacksonville, Florida, because they wanted us to take our Canadian platform and apply it for use in the United States. So we partnered with them and got the platform up and running in October of this year. So an exciting story for us as we kind of moved through and pivoted the business for where we saw opportunity.
Excellent. All right. Crystal.
I think Can Capital has a really unique and interesting entrepreneurial story. Back in 1998, one of the founding members owned a Gymboree franchise. And in the summer, she found that she needed some working capital and was unable to get the working capital she needed to expand her business. So in a very classic entrepreneurial standpoint, they were trying to solve a problem that she was actually experiencing. And in doing that, decided, I get credit card receipts and I have future receivables I'm expecting. Is there a way I could tap into that in order to, say, finance, the working capital needs I have today? And with that need and idea, kind of created what is now the Merchant Cash Advance, and using kind of the daily remittance platform in order to help fund the funds that she needed to grow the business. That was in 1998. From there, they've kind of built and continued to grow and expand the Merchant Cash Advance product through various partnerships with merchant processing partners. But I think kind of in the collapse of the economic collapse in 2008, saw a need for a business loan product as well. Again, small businesses have different needs when it comes to working capital, why they need it, when they need it, what they can base that their financing on, and really saw a need to have a fixed price, fixed term, fixed payment product. And with that, we have partnered with WebBank to be able to originate business loans in addition to the Merchant Cash Advance. So always trying to evolve the product set that we see as a demand from the small businesses that we're serving. We're always looking at ways to take the data that we have and continue to evolve that and looking for opportunities.
So I came up with the idea in 2007. The idea for Kabbage really was to create an automated platform and to leverage data that wasn't being utilized in underwriting small businesses. The theory being, if you could get access to automated data and underwrite them, you not only create a better experience for the customer because they don't have to go through the pain of any sort of manual process, and on the flip side, you could get access to data not only at the time you qualify them for cash, but on an ongoing basis that allows you to have a real-time understanding of how that business is performing today. I had gotten to know that there was a variety of companies that were opening up APIs to their back-end data, and so the theory was that the customer could actually authorize us to have access to that data. And by gaining access to that data, not only at that time, but again on a persistent basis, we'd be able to underwrite the customer. And so we went out for our, one of my first calls was to Catherine Petralia, who's my co-founder and our chief operating officer, and I told her the idea and she liked it. And I said, we should be funded in like the next couple of months, no problem. And that about like a year plus later, we finally got some funds. Not the best idea at the time to start a financial services company in the midst of the global financial crisis, but it's worked out okay. The general idea is we would have this sort of bevy, a multitude of data sources. Customers would give us access, and we'd be able to get access to that data and underwrite. And one of the primary questions we had when we first went out looking for venture is, who the heck will give you access on a persistent basis to their data? And the answer to that question is almost everybody has. It's almost never been a question for our small business owners. I think there's an understanding that you have to give a little to get a little in this business, and they also recognize the fact that they would have to go through a more difficult process if they went through a traditional route. So started the company again back in 08, 09. And immediately started sort of the daisy chain of raising money, building platform, raising money, launching the product, and we've seesawed back and forth ever since.
My story is that I consider myself wholly an accidental entrepreneur. I had been at Capital One for 12 years, worked a lot with Peter and with not James, with James actually. And the majority of my time there was spent leading credit for the National Small Business Unit at the company. And I think that serving small businesses is the highest calling. And I've always felt that that was a place where I could actually have a great career and serve my passions as well. But I think after, a long time of doing that within a really great company that was highly committed to small businesses and highly committed to innovation, I realized how difficult it was to continue to serve small businesses at the very micro end of the scale from a big institution. Every year we retreated, from the market a little bit more. And while we may not have emotionally or intellectually retreated in actual terms, we ended up having to retreat. And so it became harder and harder to do loans under 200,000. And our answer to that was, the credit card, which to me didn't seem like a really great product to lend off. Although, I booked several million of those over the years that we were there. So, what happened, I think, was, I started to look at the marketplace out there, and there were some beacons emerging around small business lending, some of which are on this, on this platform with me, and started to get excited about the idea of there's a different way to lend to small businesses. My partner, being a securities lawyer, was similarly focused on a lot of the changes that came about with the Jobs Act, which, in and of itself has been pretty much a failure in the sense of what it actually set out to achieve. But the environment that it actually launched has been very conducive and very friendly to the idea of marketplace lending, even if the specific law itself hasn't really gone anywhere. And then finally, in bringing my third co-founder, just changes in technology and in society's comfort with technology. It's been amazing to me since I've been at StreetShares how much our customers trust us and what they're prepared to do, both investors and borrowers. And that was very different from within a big bank where I felt like our customers became increasingly hostile towards us. And so I think that when you think about the comfort with technology, the ability to really tap into all of these new data sources, to be able to analyze and process them, I think that is essentially how we've built this company. And affinities for us, have a particular data story attached to them. You can understand an affinity in a very different way than you can an individual, and so that's an important part of how we think about data and analytics at our company.
Yeah, interesting. So both you guys, Rob and Mickey, talked about that relationship with the customer and kind of that give and take and partnership, which is really interesting. For the panel, what's the ideal customer? What's that ideal partnership look like for you all? Mickey, why don't we start?
So we're very focused on micro businesses. So as I said, we do loans, 50,000 and under. Our average borrower is somebody who has, probably between 5 and 10 years of military experience. They have a 700 FICO. They've been in business for 4 years. They have revenues of about $1 million, or a little bit north of that, which actually surprised me that businesses that big are actually taking loans this small. And actually, for many of them, the refrain is, I can't get a loan from my big bank, or I have a really large loan, so to get a really small loan from them is really hard, which is just a funny kind of messed up situation, but it works very well for us. So that's really our target. And then on the investor side, it's retailers who are interested in investing in marketplace lending, of which there are. We have, far more demand on the investor side than we do on the borrower side. We have all the financing we could ever need, for the foreseeable future. So that's a little bit of an easier equation for us. It's about acquiring quality borrowers.
So it makes sense for me to explain our product just a little bit. It's actually line of credit. So we provide a small business with an opportunity to take anywhere between $2,000 and $100,000. They don't have to take anything the day they set up the account. They can draw it all down day one. They can draw a portion of it and come back, and whatever their remaining open to buy is, they can draw that down in subsequent or concurrent loans on our platform. As they pay us back, it works a lot like a credit card in the sense that you replenish the principal balance that's available to you. So our customers tend to use the product for cash flow needs. They can take out an amount of cash actually to the penny. So if they want to take out $3,748.22, they can do that. They can come back a day later and do the same thing or something different. So the average customer, and we also wanted to build this automated platform concept was so that we could serve businesses that ranged literally up into the many millions of dollars in annual revenue, but also those that ranged into the tens of thousands. So we have customers that literally have $40,000, $50,000 a year in top line revenue. We have customers that have $4 and $5 million a year, and their lines and their rates, vary based on risk-based pricing and capacity and ability to repay. Average customers doing many hundreds of thousands of dollars. Our history was in the online merchant space, so we started out focusing on customers that were selling products over places like eBay and Amazon and leveraging PayPal to sell products. Over the last 18 to 24 months, we've expanded to include really any small business, as long as we can get access to the data. So now online small businesses make up about 25 or 30% of new customers, and everybody else makes up the balance. And so the whole shift has happened. I'd say each segment's growing, but it's, again, the online retail is becoming a smaller percentage of that. Average time in business, it really varies greatly. We have customers that have been in business for a year, and we have those that have been in business for over 20 years, and everything in between. But usually 3 to 5 years is the average. Average revenue, as I said, is in the many hundreds of thousands. So it started out quite low when it was online small businesses. Our average non-online small business is between $500,000 and $1 million. So that is shifting over time. So we're seeing sort of a shift, and also the nature of the industries they in really span what you might expect out there. So we have retail, of course, we have service businesses, dry cleaners, restaurants, you name it, manufacturers, a lot of service companies like marketing agencies and others that also participate on the platform.
So moving on to kind of the small business focus that we see for King Capital, we kind of think of it as the Main Street businesses. Our history has always been with the restaurants, retail, medical and dental offices, beauty, spa, and they really do range in terms of what the firmographics look like. We start maybe at $100,000 and a single location, up to a couple million in multiple locations. Anywhere from time in business could actually be a couple months up to the 20 plus years. We do see a broad range of opportunity to lend to the small business segment that's really looking for anywhere from like $2,500 to $150,000. Our average merchant probably looks somewhat similar to kind of what was just described for Kabbage. A couple years in business, 4 or 5 years in business, 500 to $1 million in revenue. And then the industries really do span. We've kind of have the suite industries that we've always focused on, but we are seeing, more demand from service industries, construction, transportation. So there are kind of new industries that are kind of constantly showing up into our marketing focus. But those have really been kind of where what our merchants look like.
So at FinanceIt, we really have two sets of customers. We have the bank customer that's looking to get loans put out through our platform. And then we have merchants that are looking to get loans attached to a transaction, ultimately for a consumer. On the merchant side, we're really looking for those merchants in verticals where there's a big ticket. The average size of the loan in our platform today is about $10,000. We'll go as low as $1,000 to $2,000. Don't love those loans, but we'll go as high as $60,000 to $70,000 on the high end, based on the credit and underwriting agreements that we have with our particular banking partners. So we're looking for big tickets, generally in home improvement, in retail, a little bit of healthcare, places like orthodontics, so kind of surprise big expenses that aren't covered under insurance, where a monthly payment plan is the perfect way to accelerate sales. So we're looking for merchants generally in the what we call the underserved category that are competing against usually larger, big box type of competitors that will be using a sales finance platform from one of the really big guys, like Synchrony, for example. Our average merchant revenue is kind of 2 to 20 million, 1 to 10 to 15 locations. Really understand the power of using point of sale financing. 6 months don't pay, 0% financing, followed by a reasonable, transparent monthly rate afterwards for their end consumer. So those are the target market on the merchant side. Our financial institution partners are usually small and mid-sized financial institutions, and 6,000 of them in the United States alone, that are struggling with origination. So the run-up to 2007, where they were buying a lot of collateralized debt objects in the secondary market or treasury assets, then that industry ended, and it's been very difficult for a lot of these small and mid-sized banks to keep originations in line with where deposits are in the banks. And the idea of buying more software and hiring more people, or offering something else in the branch, just doesn't seem very compelling. So they're our target, where we're able to go to them and say, let us do the heavy lifting, let us be the technology and operations professionals. We'll do it in such a way to meet your compliance obligation, and you can look at it in a SaaS-based, cloud-based window in real time to keep us honest during the process. And they're the sweet spot for the lender for us.
Excellent. So I want to transition to technology, analytics, big data. And this is really just open, so anyone can jump at these questions. So the first one is, with those technologies, around, you hear about Hadoop, you hear about the cloud, how have those accelerated what your business model? And also, if there are any lessons learned for this group here as you've kind of gone through that learning curve in terms of those technologies. Anyone want to jump out that one? Got it, Rob?
I'm happy to do it. So our whole business is predicated on access to data in the cloud. We like to say that 10 years ago, our business wouldn't have even been possible because most companies didn't have APIs that allowed you to gain access to data. In terms of lessons learned going through that, it's painful. We have integrated a lot of data sources. What's amazing is, QuickBooks is a good example of a data source we've integrated and that we utilize in our underwriting. But it is amazing that literally nobody enters anything in the QuickBooks the same as anybody else. It literally don't. Trying to figure out the commonality between the way customers leverage various data sources and how we can have confidence in that data has been one of the lessons learned. So we have two types of data. We have what we call verified third-party information, and that's transactional information typically, or other information that's coming from third parties, where the small business owner really doesn't have an opportunity to control the flow of that information very easily or manipulate it at all. And then we have data that falls into all the other categories. And so we've had to do two things. One is for the verified data, we can look at that and make decisions on that in a very sort of binary way. With respect to the data that is unverified and is subject to potential manipulation or variation in how it's being entered, we've had to really figure out how to use that data, build a confidence score against it, and then be able to utilize it in more binary fashion after that. So a lot of the magic in what we do is understanding these data sources. So that's probably been the biggest lesson in leveraging new data sources within the company.
Yeah, I can jump in. So, I should say I have a bit of a love-hate relationship with the whole big data movement. I think, I'm both very excited about it, but also skeptical about some of the things that are out there. And so we're very cautious about how we use it. And one of our investors mentioned to us that they had met before us with a company out on the West Coast, some very smart engineers. And after their initial presentation, they had asked how they do credit risk management, how they're going to make these loans. And the CEO's answer was, well, we didn't want to pollute our culture with credit people. And so, they didn't get the investment, as you can imagine. But there is something about being sensible about this data while also embracing it, right? There's some real opportunities here. But we think about it in there's three quick categories. Number one, as Rose mentioned, there's existing data that it's just possible to get access to that it just wasn't there before, right? I mean, QuickBooks has been around for a while, but now there's FreshBooks, there's the cloud-based accounting software is a very it's a huge development, and the fact that you can access it easily is, I think, a really positive development. So there's this existing data that you can now access. Secondly, there's really new data being created. There's new content, and a lot of this is in social media, networks which we primarily use in the fraud space to screen businesses. But there are other spaces which we're exploring. Our major investor is Axion International, which is a large global microfinance company, and one of their portfolio companies that we've been talking to basically just pulls data off your cell phone use. Now they primarily lend in Africa where there's no bureaus. Peter, you need to get onto that. But what they do is they pull things like how many calls a day is this person making? When's their earliest call? When's their latest call? How hard are they working? How much do they move around if there's GPS? Are the calls all from the same 3 numbers, or are they from 50 different numbers? So you can start to get a picture with some new data that's being created about, now, we could debate about whether that would be useful or not, but it's new data, and it would, or how useful it would be, should I say, what the degree to which it is. But there's all this new data, and then finally, there's just the ability to actually store and process it in a very efficient way. I remember 10 years ago at Capital One trying to do analysis on transaction data, just pulling all the small business transaction data, and I couldn't find a place to store the data that was big enough in the company, in Capital One, the big data company, because it was just too much. Now we've solved a lot of those issues. All of our analysts have remote desktops with unlimited storage capacity essentially in the cloud, and and there's a lot of tools and frankly companies and technologies that allow you to process through some of that. So that's how we think about it.
Excellent. You guys, any points?
Sure. A distinction of what we do versus some of the other folks that I think are really using data in an innovative way in the lending space today is that we're really focused on prime customers. We're not trying to find a way to qualify people that a bank couldn't qualify. We're trying to qualify people that a bank can qualify, and we're just trying to do it in a more innovative way. So when you think about, and I know the people who are trying to qualify people around where you would normally have a bank qualify are doing some very interesting things in data, but there's less pressure for us to have to do that. What we're really trying to do in the prime space, and I'll simplify prime lending down to 3 attributes. Can you pay? Do you pay? Will you pay? It really comes down to that assessment for us. And we try to, in our view, right, people might have a different opinion, can you pay? Are you employed? Do you have a capacity to be able to pay? So we have third-party integrations into different data sources to help us make a real-time assessment of your ability to be able to pay something back. Do you pay? Well, you guys are experts at Equifax at this, so we have a great relationship with Equifax. You didn't pay me to say that. I'll just say it anyway. And we also, some of the other bureaus, let's not talk about them, but so we have relationships with people who are experts at figuring out, do you pay? You are big data people that will tell me exactly how many trade lines are open, what their performance has been over the last 10 to 15 years of their life. And that becomes data that we rely on every day to make credit decisions. And then the subjective call is, will you pay? So that's really your guesswork now. Are you a 700 FICO that's ascending, or are you a 700 FICO that's descending? And there are, again, some great tools, and I won't sort of give all our special sauce away, that we link into to try to make that final assessment of, what is the projected likelihood that you're going to pay over time. And I'll just chime in on the same thing about being a bit of a skeptic. We've looked at a bunch of these new data sets, your Facebook social graph, your Twitter account, your eBay seller score. And right now, I'm a little bit from Missouri on this. I don't currently see any predictive value in any of those data sets yet, or anyone that's really doing anything with them. We use social networks to track down people, and I'm very open to a debate on this, but for prime consumer borrowers, we're not seeing anything. We use social networks to track down people who aren't paying. Because usually if you're not paying, you're dumb enough to post something. And then we track you down, right? And
Someone
so
tweet
that's
that?
the only
Someone
use
tweet
that we
that?
have in social. Yeah. So
It's a good collection strategy. I like it.
Respond.
Yeah.
So Rob, you want to comment on that?
No. So look, for consumer, I actually totally agree with you, because you're talking about consumer, using social consumer. I will tell you that we integrated social in September 2011. Cute name, we call it social climbing, which allows you to add your Twitter, Facebook accounts. We have found, and this varies based on activity, so small business owners use Facebook and Twitter to keep in touch with their customers. It's effectively their CRM system. So we found, on average, customers who have added that and are active per our algorithms are 19% less delinquent than customers who have not added those accounts and are not active on it. So I don't have to debate it. It's factual for us.
Okay.
Wow,
And I was
that's
just going to
great.
make a few comments about big data. I think Kin Capital's been doing big data before it was big data. With 16 years of data on a daily remittance platform where we can see real-time performance of a company every day. It's 100 million data points that sit in our database that allow us to model from, whether that's for marketing, risk purposes, customer lifetime. I think it really is that day-to-day understanding of a company's performance sooner rather than later that's helped Can continue to evolve and look at ways to continue to serve the small business market. But I will end with one funny data point that's recently shown up, as someone has thrown this out that maybe it's something we should capture, is water bills and water usage. So if you were to be tracking a restaurant, again, this is when the data starts becoming a little crazy, right? If you were to be tracking a restaurant and you were to look at their water bill and look at their water usage, if it goes up or it goes down, is that a good sign or a bad sign? Is that something we should model and then input into our actual risk-based modeling? I'm not so sure yet, but I'm in charge of product, not in charge of the risk models.
All right, so you all mentioned about using data, new data sources, and there's a tension there between kind of creepiness, privacy, and data. And so I'd love to how do you all balance that, right? Because I think there's a piece of which is you can know your customer much better than you could 5 years ago. Rob, you alluded to, hey, some of the stuff we actually like the fact that we can get these other data sources because they haven't been manipulated, right, from a lending perspective. So any challenges that you have had in your company or just points of view that you have in terms of how do you balance that for your customer? How do you enroll your customer in, hey, give us your data so that we can have a better product solution for you?
So we're a marketplace. So we put our borrowers on a marketplace. Now it's a closed marketplace. We have it's accredited retail investors and institutional investors. But nevertheless, if you go on and you choose not to invest in an automated way, but actually go do loan picking, then you can look at what's the business. You can look at all their social networks that that we've been able to track down. You can look at financials and cash flows and things like that. And so so we have to think about it in a couple of different ways. And I would say that firstly is just security. So we're very transparent with the customers about all the security that we have in place, and we have as much security as we can possibly afford. So we have a tremendous amount of security, but in order for them to give us the data, we do want to make sure they understand security that's on there and how we retain data and how we don't retain data. Secondly, we do employ opt-outs for customers, so even on public data, right? So much of the social stuff is just out there. We've just We've just compiled it. But we still allow customers to say, I would rather investors not look at, at this sort of portion, or that portion. And I would say just the final thing is that we hold ourselves to consumer lending standards, which are actually, they're much stronger than lending standards for small businesses. So in terms of how we think about FCRA, how we think about Reg B, how we think about informing customers why they've been turned down. We won't use attributes in things like turndowns that we wouldn't be comfortable disclosing to them or that we think would be unlawful under a consumer regulation. So we're pretty cautious about that. Doesn't mean that it couldn't be used in either pricing or marketing, but on the turndown reason, we're pretty careful about it.
So I'll echo. We also really follow consumer lending regulations. We are also in a relationship with the Utah ILC, so we're also subject to the same sort of regulatory scrutiny that Capital Access Network is on that score. As I described, our customers actually authorize us to gain access to the data. We don't share it with any third party. The only folks that we share that data back with is actually our customers, who oftentimes don't even realize what their data shows. And so we have a big focus on doing that. The other flip side of the privacy coin, and something that I've spent a lot of time talking with folks about, is privacy is about keeping your information private. At the same time, the flip side of that is allowing our small business owners to really own their data. And one of the key initiatives for us is try to convince more third parties to make their data about their customers available to third parties that their customers want that data to be shared with. There's still a lot of companies that resist that or make it very difficult for their customers to actually get access to their own information and download it or port it over to somebody else. And so we spent a lot of time trying to focus on that issue, which we always call the flip side of the privacy coin.
Sure. So I'll chime in as well. Very similar to the other folks that have spoken. For us, it's very important to ensure that we're disclosing what data we're taking from the customer or we're going to take from the customer after the fact. And it's especially relevant for consumers. For the merchants, we tell the merchants during the underwriting process, because we don't lend to merchants, but we lend through merchants. So we have to follow a set of underwriting guidelines associated with merchants. And we get lots of complaints about the number of things that we ask them for and they have to provide to us, as well as us saying that we're going to go look it up. And getting their permission. So we try to be very open about that. And the same thing with the consumer. I think one of the complaints I've heard before around some of the online lending platforms for consumers is that they didn't really realize when they were clicking all the I agree buttons, what they were actually agreeing to. So we really try to slow the workflow down for people at our own expense sometimes and make sure that the consumers understand what it is that they're agreeing to. Our documents come up and you have to spend a certain amount of prescribed time looking at them so we know you're actually reading them. We try to take the important things and put them on the first page, not bury them in 8-point font on the back page. So we're trying to do this differently than some of the folks that had come before us. We'll test and learn, right? But the principle for us is around disclosure, getting a cooperative agreement from people, being transparent about the things that we're doing and why we're doing them.
Excellent. So let me ask the final question here, then we'll open up for the audience to ask questions. So, and this relates to the poll question. So how do you see your business affecting traditional banks in the long run?
I go really quickly. We love banks. They're our customers. I don't exist without banks, right? Because they're the lending capital every day that shows up on the platform. Simple.
We have a relationship with WebBank, so we also really like banks. But
well, more. So let me rephrase it a little bit. We all love banks.
We love
Let's
banks.
get that over with. They're our friends. We don't want to be cut off. But it's more about, will they adapt to your business model, and do you see this as being a viable strategy for banks in the future?
I see us in some ways maybe as a potential to be in addition to the business model. So, if there's still demand for small business lending that banks today still can't meet, can Capital serve as that additional platform so that they're able to offer access to working capital to all the small businesses? So they're not necessarily turning somebody down for a loan, but they have an alternative that they can offer.
So for Kabbage, we have two spokes to our model. One is direct business, small business. I didn't mention we also have a consumer product on the market called Carrot. And on the other side, we have a very robust business with banks. We are actively working with several banks that are utilizing our platform and other financial institutions to make loans available to their customers, leveraging at least a portion of their own balance sheet as well as their relationship with the customers. This is happening both here in the U.S. As well as we'll be announcing a deal soon and launching our platform in Q2 in Australia. And we'll also be announcing a deal over the next 6 months for Europe, not UK, but for mainland Europe. So our view on financial institutions is they're a primary part of our future, and we want to enable those financial institutions to provide capital to both consumers and small businesses in sort of unique and very automated ways.
Yeah, I'd just say similarly, we have banks on both sides of our marketplace, so both as investors and as referrers of customers who, when they realize how we can book customers and how cheaply we can book customers, they're willing to refer them to us. The second place where I think we see partnerships with banks emerging is we've had discussions with several banks about actually just creating private label versions of our platform purely for their customer base, so that their customer base can essentially lend and borrow from within their banking ecosystem, which is most of those discussions are more international focused, but there's at least one institution here that's interested in that, which I think is that's an interesting and bold I think use of our platform that we had not anticipated earlier on.
I think there was someone in the back. Someone can get him a microphone back there.
Yeah, this question's for the panel. I'm curious to know, going back to your early days, how you guys addressed the chicken and the egg problem of building a credit model before you had all the data that you needed to assess credit risk. I mean, how did you guys get going?
We guessed, for the most part. That's the truth. I mean, it literally is the truth. It was an educated guess, but what we wanted to do was try to use what we thought were metrics that made sense in terms of whether we should provide capital, and if so, how much, as well as the attendant rate. And the most important part of that was to collect as much information at the commencement of the relationship that we possibly could. And then as we saw the repayment behavior, tying that repayment behavior back to the criteria that we saw upon origination so that we could build models and evolve our models over time. And we have obviously origination models, and because we're aligned, we have returning customer models, many, many dozens of different models that are operating at any given time and lots of champion challengers. But I have to tell you, in the beginning, if you were a small business and you were generating at least $1,000 in revenue, it was quite likely you were going to get some offer from us. Our objective was to build a model that was very different than utilizing the FICO score of the small business owner. So it was really important for us to do. And the only way you can do that is to give almost all small businesses at least access to some capital and then figuring out that model. We called it R&D. Others may call it charge-offs. But that's what we did.
That's great. Our model was a little simpler to do because, again, it's prime lending. Our partner at Equifax certainly had a lot of data to help us make good credit decisions on behalf of the banks that we worked with. We were conservative at first, and the consequence of us being conservative, to the person behind the light back there. So the consequences of being conservative was that we had a lower approval rate than our merchants would ultimately have liked us to have. So the struggle that we had in the beginning was just keeping merchants happy when we were being conservative. And we had this interplay. The bank was happy because they got a whole bunch of good quality customers and didn't have to take a lot of risk. But for us in the marketplace, it meant that we needed to find ways of convincing our bank partners to stretch in the way that they looked at credit. And we've continued to do that. We've increased our buy rates by about 35% over the last 3 years by educating our banking partners to move with us and make credit decisions.
Hi, could you give us an idea of your average or range of typical cost of capital your borrowers are paying?
Average cost of capital to the borrowers themselves, not our cost of capital.
your rates or something on.
Like
Yeah,
an
so-
APR, are you asking what the average APR is for borrowing?
Yeah, just a range. I know you've got prime, and the others have, probably a lot higher annualized type of cost to the borrowers. I'm just curious what ranges.
Yeah, our average range is in the mid-teens. We do loans as low as around 8%, and some of our loans will go into the mid-20s. So we do a range between 8 and 25%, with mid-teens being the average. And we do all sort of 1 and 3 year fully amortizing loans, just so it's clear what the product is.
So we charge on a loan basis, we charge between 1.5% and 20% of whatever we loan. That translates into APRs that range from about 18% up to the upper double digits. Average APRs are typically in the upper 30s to low 40s.
I was going to say, and we don't usually speak in APR more about price ratio, but some of our lending starts at 99% and kind of goes up from there, depending on the term, the amount, and the credit risk of the merchant.
And we're on the consumer side and in prime, so it's 6 to 14% is our spread, and it depends what vertical you're in. So home improvement, we're lower, retail, we're higher, because our competition in retail is credit card, and they'll be, instead of lending to a homeowner. So some of those things are factored into the way we do pricing. And then the rate is oftentimes purchased down by the merchant. So the merchant will offer a 1.9 APR financing to the end consumer, and they'll buy that as a program from us and our bank.
Help me thank this panel for their candor and really just explaining it all. Thank you, guys.